Capital. Saurabh, thank you for coming down once again.
My pleasure. Thanks for having me.
Saurabh, is the street really overestimating all this GST related disruption?
I think the street is both overestimating perhaps the extent of the near-term disruption, but I think the markets are also underestimating the extent to which our country is changing. And it's not just GST, it's a whole sort of package of changes, package of reforms that the NDA has thrust upon the economy. It's the Black Money Crackdown, the Real Estate Regulatory Act, Benami Transactions Act, demonetization, GST. And what all of this is going to do in totality is probably change the economy more fundamentally, more profoundly than even the 1991 reforms did. The winners will be big and few, and the losers will be many and small. And that sort of rebalancing of the economy, I don't think the market's really understanding. And all fairness to the markets, it's tough to figure out at the moment. There's a few winners who are going to win big time out of this, but there are lots and lots of small businesses who over the next couple of years will probably wind down their shutters.
We'll do a thesis nevertheless, Saurabh, on what works and what doesn't. But I just wanted to probe that a bit. Is it too difficult right now to try and figure out what businesses will gain and what won't? Because you speak to any retail store owner or otherwise in Mumbai or Kolkata or Hubli for that matter, the answer is the same. Pata nahi hai kya hoga.
Yes, so we understand the broad dimensions of the change. What's very hard to do, Niraj, is to calibrate the dimensions. So let me just explain that. So for example, in the plywood sector, we know that the listed market leader will consolidate market share. And amongst, say, the 3,000 plywood manufacturers in India, we know that the bottom third, between 700 to 1,000 companies will have to wind down. They've never paid tax before. They neither do they have the IT systems and processes in place, both from a profitability and from an admin standpoint. Over the next 3, 4, 5 months, they'll go out of existence. If they go out of existence, the market leading player gets more market share. He presumably gets better pricing as well because the lowest cost guy is out of the equation. However, remember, as this happens in hundreds and hundreds of firms, you have SME owners whose income dwindles, disappears, and you have large scale unemployment. So when you have large scale unemployment, as remember, 90% of Indians work in companies with less than 100 employees, right? So as the SME owner goes out of existence and he lays off workers, demand gets hit. So I benefit from my market share gains as an organized sector market leader. I benefit from pricing gains, but I also might have a lower market, a smaller market to cater to, at least over the next couple of years, when demand could stay muted in the economy as a whole. And the calibration of the positives versus the negatives is still not very easy to do.
So that's the long term. My question is, a lot of people are citing that there will be disruption in the short term. Is it difficult to figure that out? No,
that I think is reasonably straightforward. It's upon us because the extent of the admin changes obviously are epic here. For larger companies, they've obviously got consultants.
No, sectorally, Saurabh, or thematically.
So thematically, the impact on the SME sector, the impact on the informal sector, the ripple-on impact on lenders to the SME sector, some degree of consumption slowdown in the short term. I think those are reasonably easy to foresee.
Okay.
What's harder to foresee is the extent of the negative and the extent of the positive, and which one outweighs the other over the next couple of years. So, for a quarter, perhaps a couple of quarters, we will see a demand slowdown and an admin hassle, and companies therefore necessarily will tell the market rightly to look through the first 2 quarters of FY18. What companies themselves don't know, in all fairness, is will the slowdown be 1 or 2 quarters
or more,
or is it 3 or 4 quarters? Nobody really knows at this juncture.
So if indeed we do see a significant hit coming in on the revenues for the first 2 quarters, the first half of FY18 itself, do you see a probability of the questions over current valuations coming back? And again, is there a possibility that we see a correction? I know you have a Sensex target of about 31,000 for the year, so almost there.
So if you look at what's happened in India over the last 5 years, we haven't really seen meaningful earnings growth. We haven't seen double-digit earnings growth for 5 years now. And in that 5-year period, broadly for 3 or so years, investors were concerned about the lack of earnings growth. And over the last year or so, especially the last 6-7 months, investors have abandoned their concerns about earnings growth, and they're looking through and saying and hoping that the earnings will fructify. They're buying in hope rather than buying on the basis of earnings. Now, there is a chance that investors continue to buy stocks on hope, and valuations both in the bond market and the equity market. Remember the bond bubble, I keep saying the bond bubble is far bigger than the overvaluation in equities.
It's starting to unravel on the global front a bit.
So that's where I think the Indian challenge lies. It is possible that investors look through the near-term slowdown and keep buying, but I think the bond market is in a fairly fragile state now. It's got so overstretched. Bond valuations or spreads have crunched to such a level that I think it's simply not tenable to believe that in a country where the banking system is as stricken as it is, where beleaguered promoters are borrowing as much money as they are from bond funds, it's not credible to believe that bond funds can carry on, continue go through this without a hit on their NAV. So if the bond funds start seeing hits on their NAV, if investors start losing faith in bond funds, that's where I think the equity market knockoff impact could happen. So it is possible that just like because of the demon experience, investors say, let's just ignore the near-term pain and the near-term noise and keep buying through this. But I think there's a reasonably high possibility that a combination of global factors and local factors will bring a fair bit of reality, a fair bit of realism, sobriety back into investment behavior, and therefore a correction in valuations starting with the bond market and then going on to the equity market, I think is more likely than not in the next 6 months.
Oh, that's a lot of GST. I have some other stuff, but if you have any GST related questions more.
No, so just one more thing, Saurabh. In terms of reforms, if we can loosely use that term, what the RBI is doing over the last a month and a half or 2 months, and I think they've moved with a pace which has surprised many. Everybody thought that, hey, these new reforms have come in, I think over 6 or 8 or 9 months because of the comments made by RBI. It'll take some doing and then it'll fall away. I think the pace at which RBI has moved about has surprised a lot of people, positively I might add. Do you believe that this process will finally help debt resolution, NPA resolution for banks? And is this a net positive for banks by and large, corporate facing banks?
I think both in GST and in the RBI's moves, remember the RBI moves are only happening because Delhi passed that ordinance allowing the RBI to do this.
True.
I think what the authorities are saying in Bombay and Delhi is, let's take the pain now rather than waiting for next year. Let's take the pain now. Let's sort of hit whether it's in GST and the economic pain associated with rolling out GST or with respect to provisioning and the hits to the bank's balance sheets. Let's take the pain now rather than waiting forever. Now coming on to will it work? Of the 12, I think 12 companies that have been prioritized,
or 55 next as well.
Overall 55, but starting with 12. I fear that there is very little value left inside them. So whilst I don't doubt that the bankruptcy process will be applied, the insolvency process will be applied, the waterfall structure, secured creditors, unsecured creditors. I think there will be an attempt to apply that. My fear is there's very little value left inside these companies. And the reason for that is it's been such a long time that these companies got into trouble, that because of the delay in bringing them to sort of holding them accountable, I think whatever had to be stripped out of these companies has long been stripped out. But be that as it may, the fact that it's happening, the very fact that it's happening, that powerful corporate interests are being held accountable for money that they didn't repay, for loans that they didn't repay, I think that sets a very powerful example. It sets a very powerful precedent, and the fact that the entire financial community will see that from now on you can't with impunity default on large loans will, I think, improve the credit culture in our country, and potentially it'll create a situation where you can actually do profitable commercial lending. So far in India, my analysis suggests not a single bank has managed to do profitable commercial lending on a cross-cycle basis. Public or private, profitable commercial lending on a cross-cycle basis has been a fiction rather than fact. I think these current developments might change that construct.
All right. How do you see these beaten down IT and pharma names? And do you see any value or contrarian calls in any of these names?
So I can't say that those entire sectors are worth buying, but clearly in the pharma sector, you have names where the companies have very low dependence. There are certain pharma companies. In fact, if you leave aside the top 4 pharma names, the rest of them have low dependence on the states. Several of them have high ROCs, good cash flows, healthy operating margins, non-existent debt, no debt at all, and their valuations are at 16, 17, 18 times. So I think that there is value there in those sorts of names. Low American exposure, good financial position, high cash flow generation. I'm a fan of those sorts of pharma names. In IT, unfortunately, one has to be a little bit more selective because in IT, the American exposure is almost a given. But even in IT, the EPS growth expectations of some of the larger pharma names, larger IT names is 1 or 2%. And you know, if you take some of the premium names in Indian IT, ROCs are approaching 30%. They've returned, there's a strong commitment to return cash, and just on the basis of cash, returning cash alone, some of them are trading at effective dividend deals, i.e. dividend plus buyback of around 6-7%. If you give me 6-7% dividend yield on an Indian IT stock and I'm able to get it at 15 times earnings, I think I'm interested.
That would probably make a lot of people. My final question to you, Saurabh, is this, so you know, the opinion is divided. A lot of people say that mid caps and small caps trade at frothy valuations. I rubbish that argument primarily because it's such a wide space that you'll always find companies which are not trading at those frothy valuations as well, but they get branded in the same pocket. Is it a good time to fish around for the non-Nifty, non-BSE 200 names?
So look, I think there's never a good time to fish around for names, in the sense that I've always believed that there's only 30 to 50 investable stocks in the country. I think it's pretty much that.
Yeah, people try to find that next multi-bagger.
So I think that effort is always bound to be a little speculative.
Okay.
The point I'm getting at is, if you buy high quality names, companies who are consistently generating healthy ROCs, healthy revenue growth, good corporate governance practices, if you buy high quality names, and you're willing to be a little patient, it doesn't matter at what stage of the market you buy them, bull market, bear market. On the other hand, if you're a speculator and you try to make a short, you want to make a quick buck, I think you're better off doing that when valuations are cheap. For speculators, cheap valuations are very important. Clearly, valuations today are not cheap. For investors, fundamentally oriented investors who want high quality names and are willing to be patient in holding stocks for 3, 5, 10 years, the entry period valuation is not really that relevant.
But I mean, I can flip that argument around and say that, hey, for example, a CDSL, which is listed today, is a high quality name, but it's not in the top 200 names, so to say.
With any of these companies who are IPOing, it's very hard to know whether they're high quality or not until the track record comes through. And by track record, you know, I'm the sort of conservative person who looks for 10-year track records.
Sure, okay.
I've never really put money, believe it or not, I've never put money in a company unless I've seen 10 years of track record. Okay. I don't have that much, so whatever I have to invest carefully. So I've never quite understood how people are able to participate in IPOs, especially retail investors, how they're able to participate in IPOs with quite the sort of enthusiasm I'm seeing. They clearly have a far more faith in the institutions of our country than I do.
Fair enough, but then where do you see those next set of multi-baggers coming from, or which do you believe are the themes which are going to dominate for the next?
So I think it's interesting that you asked that question, because when we sat I sat in your studio 7 months ago, and when we published the Unusual Billionaires, what the Unusual Billionaires says, and thanks to you, the book has done very well. It's sold 21,000 copies. What the Unusual Billionaires says is that all you have to do is look back at the preceding 10 years worth of financial performance and look for companies which are able to pass 2 tests. Test 1 is at least 10% revenue growth each year, not CAGR, at least 10% revenue growth each year. And the second test that the company needs to pass is at least 15% return on capital employed each year. There's typically in India 15 to 20 companies who pass the test. If you buy them as a portfolio, sit tight for a decade, you'll compound at between 22 to 32%. That's what the book says. And thankfully, the people have bought into the message. At least the sales of the book will suggest that. But it's as simple as that, is that you just look back, find companies which have delivered. They might be expensive, but you don't kill yourself thinking about the PE multiple. Because you're giving this time, you're giving it a 10-year run, there's a high probability you make money from the quality of the fundamentals that you're buying into. The other type of investing, the sort of investing we were discussing a minute ago is, you look at companies coming into IPO and you sort of, you try your luck. The reason I'm saying you try your luck is if you look at IPOs in India over the last 10 years, only 15 out of 100 IPOs have actually given returns higher than inflation. Forget market beating returns, 15 out of 100 IPOs have given returns higher than inflation, and that's broadly representative of the broader market as well. 90% of Indian stocks don't even give returns comparable to the rate of inflation. So I'm in the conservative investing camp. I'm in the camp which wants to make money rather than speculate, and hence the unusual billionaires type of approach.
Have you tried to plug in FY17 numbers and run those two tests to figure out which the next set of billionaires?
So we're waiting for the annual report season to end, and you'll get the next year's you'll get the FY17 coffee can portfolio hopefully in the next 4 or 5 months.
Great. All right, Saurabh, thank you so much for joining us. And as for you guys, that's all for this edition of TGIF. But do continue to stay tuned into BloombergQuint as we bring you more on GST.